Hi there everybody and welcome back to another video. Today I would actually like to cover a topic here on the channel that, to my surprise, I have yet to cover, and that is ETFs, otherwise known as exchange traded funds. And I pretty much just want to go exactly what they are, what my favorites are, and give a couple of examples as to how these ETFs can actually benefit your financial future, especially for people that don't want to do any really thorough investing when it comes to individual companies. And ETFs is actually a great way to essentially invest without having to worry about any worries of default. So with that said, guys, let's get started with this video. Now, before we actually get started with examples, I would actually like to cover what an ETF is, just for everybody who doesn't know. So basically, from Investopedia, we got an exchange traded fund. ETF is a type of pooled investment security that operates much like a mutual fund, which, by the way, mutual funds similar to ETFs, but we're not going to cover them. I personally prefer ETFs. They're significantly cheaper, and I will explain that in just one second. Typically, ETFs will track a particular index, sector, commodity, or other assets. But unlike mutual funds, ETFs can be purchased or sold on the stock exchange the same way that a regular stock can. An ETF can be structured to track anything from the price of an individual commodity to a large diverse collection of securities. ETFs can even be structured to track specific investment strategies. Pretty much, guys, it is essentially a type of security that tracks a specific type of asset that you essentially want. In this video, we're mainly going to focus on the particular index sector because I believe that those are the most, I guess, known, right? When you have like things like the S&P 500, the NASDAQ, and the Dow, there are ETFs that track these indexes, and that essentially lets you buy into these indexes through an easy method. So that is essentially what an ETF is, guys. And well, there's actually a ton of them, so it can be a little bit daunting as to which ones you would want to buy. Here's a list of pretty much all of them, right? And there's a ton. There's pretty much an ETF for everything. We got value, we got the NASDAQ, we got, look at this, Bank of Montreal. It's just absolutely gold shares, right? But my personal three favorites is SCHD, VIG, and VOO. And I have several reasons as to why I like most of these, right? Pretty much SCHD and VIG mainly have to do with dividends. VIG tracks a bunch of dividend companies, while SCHD has a massive dividend yield of 3.7, which is huge, with a 5-year CAGR of 13.32. And the reason why I like VOO is because this one tracks the S&P 500. This is the Vanguard S&P 500 ETF, and it essentially tracks the S&P 500 index, which has 500 companies. So essentially, when you buy into ETFs like this one, for example, you are essentially buying into all S&P 500 companies. Think about that. You are essentially putting all your money into 500 different companies, which is great diversification. However, a lot of you guys are probably saying, well, why not SPY? Why not SPY? Well, there's a reason for that, which I'm going to get in just one second. But essentially, SPY and VOO are pretty much the same thing. But the reason why I actually prefer VOO, and by the way, this is the one I'm going to use as pretty much all examples because it is the S&P 500. It is essentially the benchmark when it comes to all ETFs. The reason is because ETFs, guys, unfortunately has something called an expense ratio. And this was actually something that a lot of people don't know. And well, it's kind of worrying when you first hear about it because you're like, expense ratio, what is that? Well, it is basically the cost of owning a mutual fund or exchange traded fund. Because essentially, when you buy into these ETFs, it takes a certain amount of money to essentially keep it running, to keep it operational. And that expense ratio, it is what is used to keep this ETF alive. Now, you're probably saying, wait a minute, there is a cost to owning these ETFs? Yes, it actually is. And this pretty much varies with every single ETF that you buy. Some of them are more, some of them are less. So ideally, you would like to get ones that are essentially a lot less, because that means the lower the expense ratio, the less cost it takes away from your gains. And this is essentially why I actually prefer all of these ETFs aside from any others, because of the fact that they have a really, really low expense ratio. Here we have VOO's expense ratio, 0.03, VIG, 0.06, and SCHD 0.06. Now, as I said, VOO and SPY are essentially the two ETFs that track the S&P 500. One is from Vanguard, the other one is from the Spider Index. And if we actually take a look at the SPDR ETF of SPY, we can actually see that their expense ratio is 0.09%. Now, you're probably saying, well, what's 0.09 to 0.03? Well, what an expense ratio pretty much is that per every $1,000 that you put in, when it comes to SPY, you are paying, get ready for this, 90 cents. Per every $1,000 you put in, you are paying 90 cents. That's absolutely nothing, right? And when it comes to VOO, well, same principles apply. For every $1,000, you get charged essentially 30 cents. So it's a significant difference. They're probably saying, what is a 60-cent difference? That's absolutely nothing. Well, when you get into the several millions of dollars, it actually does come into effect by a whole lot. So that's essentially why I actually prefer the VOO Vanguard S&P 500 ETF over the SPY ETF. That's essentially that. You can't really go wrong with either or, but just from a pragmatic sense, this one is significantly much better when it comes to overall returns. Now, speaking of overall returns, let's actually put some of these into a calculator. I'm going to assume that you want to invest into an ETF for retirement. So let's assume that you are putting this into a non-taxable account, meaning that you can only put $6,000 per year into this portfolio. So I actually have already inputted some of these numbers in. And let's just begin with an initial investment, guys, of around $6,000. Essentially, you're putting in the first year's investment already, day one, $6,000. And every single year, you're putting in another $6,000 because that is the cap that you can put in for essentially like a Roth IRA. And normally, the yearly expected investment of return is around 10% or so for the S&P 500 over a several decade period. And since I said we're going to be using the Vanguard S&P 500 ETF for this, let's say that the expense ratio is 0.03%. Just like you guys saw over here, 0.03%. Again, what that means is that per every $1,000 that you invest, you are paying 30 cents. And let's say that you are around 30 years old, right? Your situation might be different. You're around 30 years old, but you plan on retiring at age 65. So that means that you're going to invest every single year consistently for 35 years. And after doing this, guys, this puts you at a total future value of investment of, look at this, almost $1.8 million in retirement. That is absolutely crazy. And remember how I said that this ETF costs you at 0.03%? Well, this is essentially how much the ETF's total cost would be after this amount of time, and that is $12,777. Now, you're pretty much just saying $12,000, that's a lot. Right, except that, remember, you are essentially taking out all thinking. You have no risk at all when it comes to like a company defaulting. You essentially don't even have to worry about cash flows or anything of the sort because an ETF is self-regulating. If a company has less cash flow and it falls out of that ETF, like for example, if let's just say, for example, a company in the S&P 500 can no longer qualify for the S&P 500, it'll get kicked out and then another one will be replaced in its place. So there really is no thought on your end or any kind of control over your end just to make sure that you don't actually lose all your money because it's self-regulating. If a company makes less cash flow, the ETF will just self-regulate and boom, you're gonna be fine. So the fact that you are investing for 35 consecutive years, putting in $6,000 every single year, paying $12,777 for that kind of just peace of mind that everything will be okay, that it doesn't matter, I will end up essentially with $1.8 million in retirement. That's absolutely insane, right? So as you can see, when it comes to this, you're still ending up with a whole lot of money. Now, let's actually bring this to now the SPY ETF, because the SPY ETF, as remember, it was a 0.09. So let's actually see how much of a difference that is if we actually go here to 0.09%. And doing this, guys, we can see that before it was what, $12,000 in ETF costs? Well, now it is $38,000 in total cost of ETFs. And now instead of almost 1.8, you are at 1.75. So yeah, it was a big chunk. That's essentially what I'm saying, that 0.09% is actually, may not seem like a lot, 30-cent difference may not seem like a lot, but once you start getting into these millions of dollars, it's essentially a lot, right? I mean, from $12,000 in total cost of ETFs to almost 40,000. That's absolutely massive. However, we are still missing, guys, one very, very important part when it comes to ETFs, and that is essentially their dividends. Now remember, ETFs do pay out a dividend, and just like a normal company, they do pay it quarterly and sometimes monthly. When it comes to VOO, we actually see that their current dividend yield is around 1.5%, which is actually $1.43 per share for an annual payout of $5.65. There is no payout ratio because there is no cash flow to this, right? The 5-year CAGR is actually 6.17, and they have grown this dividend for 0 consecutive years. So you have some years where it goes up and some years where it comes down, but overall, it's still fairly decent when it comes to a dividend paying ETF. And in regards to VOO, they do pay their dividends quarterly. Last ex-dividend date was actually on June 29th, and their payout date was on July 5th. So let's actually say that you invest into this ETF, the VOO ETF, for 35 consecutive years, and you essentially reinvest all your dividends. You take no money out of that at all. You reinvest all your dividends, and on top of that, you're also putting in $6,000 every single year to essentially max your Roth IRA. So unfortunately, there really is no calculator when it comes to this. However, shout out to another YouTuber, Dividend Growth Investing, where he actually made a dividend reinvestment calculator. And even though this is really good for like a dividend portfolio, we can still modify this and put this to a specific individual ETF like the VOO. Only thing we have to do is just change everything up here to specifically what we want. So let's actually do this just like we did the other one. Initial investment, $6,000. Annual deposits, $6,000. Same reasons as before. Capital appreciation of 9.97%, just like we saw over here when we had the 0.03 expense ratio, right? Effective investment return, 9.97%. A dividend growth of 8.59. Now this specific dividend growth, guys, I am getting from the VOO Seeking Alpha site, where we can actually see right here that the dividend growth rate 10-year CAGR for VOO, it is 8.59%, where the median of all ETFs is around 7.04%. The current yield of 1.48%, just like we saw over here, 1.48%. And let's say that inflation is at 2%. I know it's a lot higher right now, but on average, let's say 2%. Once we input this, guys, this pretty much just gives us every single year a timeline, a time horizon up to 35 years. And if we actually scroll down here, I essentially just added this part. End of the year portfolio after 35 years, you will have $2.37 million if you reinvest this dividend. And on top of that, if you do this for 35 years, you would actually be getting on a yearly basis a little bit less than $23,100 in dividends every single year. Imagine getting, guys, essentially $23,100 just for existing. That is absolutely insane. That's essentially minimum wage today. So think about that. So as you can see, it is a massive, massive difference when we take a look at this one with no dividends reinvested, where you have $1.78 million at the end of the portfolio's life. And when it comes to this one, you're at $2.37 million. Massive, massive difference when it comes to dividends reinvesting. And it really does help overall just compound your entire portfolio. And if we actually come down here, this is just a graph of all the data up here as well, that you can just see the massive compounding that this portfolio generates when you reinvest those dividends. So overall, when it comes to ETF investing, I gotta say, I like it. However, for me, I personally like investing into companies a lot more. And as you can see, you know, you do end up with a lot of money, $2.37 million, especially if you do this every single year, right? For the next 35 years. However, guys, this does not take into account one very specific thing, and that is when the market tumbles, you actually want to invest a little bit more aggressive. If you only have $6,000 for the entire year to invest into like a Roth IRA, and you see that, you know, the market falls 1 month out of the year, like 5% or so, you may want to actually put the rest of that balance into the ETF of your choosing, just so that way you can actually get a higher return for it. Because think about it, if the S&P 500, for example, this one, which is currently at $392, falls to like $300, and you put in $1,000, you're essentially getting more shares at $300 than at $392. So unfortunately, this does not take into account the human part of it as well, that which something I always promote, is that when you see the market fall, that is not a time to get fearful. That is a time to get greedy, especially when it comes to ETFs, because at this point, you really have nothing to lose. You essentially take out all risk when it comes to investing in ETFs. So if you are thinking about solely investing in ETFs, or you probably just are like, I don't want to deal with cash flows, I don't want to deal with discounted free cash flow, I don't care about what company, I just want to invest for retirement and that's about it. Passive investing. Guys, choose an ETF. I've given you guys 3. Again, this is not financial advice, but I've shown you guys my top 3 favorite, and be consistent when it comes to your investing. Choose a specific day out of the month and have your portfolio automatically take, $100 or $600 out of your bank account, and to just automatically just put into your portfolio and to have it reinvested automatically with dividends as well over several decades. And then you will essentially have $2.37 million, or if not more, depending how much you invest overall. But that pretty much does it for this video, everybody. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. Instead, this is not financial advice, guys. And when it comes to this dividend compounding calculator, I would love to give it to all of you, but this is not mine, so I have to give credit where credit is due. Shout out to Dividend Growth Investing. He has a video, I think he just made up one recently actually, where he shows this calculator. I've altered it obviously to my personal preference, but you can get his on his channel, so shout out to him for actually making it. And when it comes to all these other sites, if you guys want, I could put it in the link in the description. But overall, when it comes to ETFs, guys, 100% one of the greatest passive strategies to invest in, especially if you just don't want to think about anything. So once again, thank you all so much. Like if you like, comment, subscribe, really does help. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next video.